What if you could start investing with just $100? Today, I'm showing you 5 penny stocks under $5 that small investors can watch in 2025. But before you rush to buy, I'll reveal the critical mistakes beginners make that cost them money. I'm your name, and this is Stock Mind Academy. Let's get started. First things first, what exactly are penny stocks? These are simply stocks trading under $5 per share. They're usually smaller companies with big growth potential. But here's the reality check. They're also high risk. Penny stocks are volatile. Prices can jump 30% in a day, but they can also crash just as fast. That's why my golden rule is this. Only invest money you're willing to lose completely. Keep penny stocks to just 5 to 10% of your total portfolio. This is your learning money, not your life savings. And let me tell you something most YouTubers won't say. Penny stocks are not a get-rich-quick scheme. Yes, you hear stories about people turning $500 into $5,000. But for every success story, there are 10 people who lost everything. The difference? Knowledge and discipline. That's exactly what we're building here at Stock Mind Academy. Before I reveal those 5 stocks, you need to know these rules. Call them my penny stock survival guide. Rule number 1. Always check trading volume. If a stock trades less than 500,000 shares daily, it's too risky. Low volume means when you want to sell, you might not find buyers. Imagine this. You see your stock jump 50% and you want to cash out, but nobody's buying. You're stuck watching the price fall back down. That's the nightmare of low volume stocks. Rule number 2. Watch out for pump and dump schemes. If you see massive hype on Reddit or Twitter, but the company has no real revenue or product, run away. Here's how these scams work. Someone buys a ton of cheap shares, then hypes it up online. Beginners rush in, price goes up, and the scammer sells everything, leaving you holding worthless shares. Hype without fundamentals equals disaster. Rule number 3. Look for a catalyst. That's finance speak for a reason. The stock might go up. New product launches, partnerships, FDA approvals, government contracts, these are catalysts. No catalysts? Don't invest. Think of it like this. Would you bet on a football team without knowing who they're replaying against, or if their star player is injured? Of course not. Same logic applies here. Rule number 4, and this is crucial, set a stop loss. Let's say you buy a stock at $3. Set a stop loss at $2.50, or wherever you decide your maximum loss is. This automatically sells your shares if the price drops to that level. It's your safety net. Many beginners skip this and watch their $1,000 investment turn into $200 because they kept hoping it would bounce back. Rule number 5. Never put all your money in one penny stock. If you have $500 to invest in penny stocks, split it across at least 3 to 4 different stocks in different sectors. This is called diversification, and it's your best friend. One stock crashes. You've still got others that might succeed. Got it. Let's look at those 5 stock categories now, and I'll teach you exactly what to look for in each one. Stock category number 1, biotech companies around $2 to $4. These are exciting because one FDA approval can double or triple your investment overnight. But here's what you need to understand about biotech. These companies are developing drugs or medical treatments. The FDA approval process has multiple phases. Phase 1 tests safety on a small group. Phase 2 tests effectiveness on a larger group. Phase 3 is the big one, large-scale testing that determines if the drug works and is safe enough for public use. You want to look for companies in Phase 2 or Phase 3 clinical trials with results coming in the next 3 to 6 months. Why? Because that's when the stock can move significantly. Check they have enough cash to survive until approval. This is called cash runway. Go to their investor relations page. Look at their latest quarterly report and find the cash and cash equivalents line. Divide that by their quarterly operating expenses. If the answer is less than 2, they might run out of money before getting FDA approval. That's dangerous. Here's a practical example. Let's say XYZ Biotech is trading at $3.50. They're in Phase 3 trials for a diabetes drug with results expected in August 2025. They have $20 million. Cash and burn $4 million per quarter. That's 5 quarters of runway good. They have no competing drugs in their pipeline, draining cash even better. The diabetes drug market is worth billions. Huge potential. That's a stock worth watching closely. Second category, renewable energy plays. With the global push toward clean energy, small solar, wind, or EV charging companies under $5 have serious potential. The U.S. Inflation Reduction Act allocated billions for clean energy. Europe is going green. China is investing heavily. The sector has massive government support. What should you look for? Government contracts are gold. If a small company wins a contract to install EV chargers across a state, that's guaranteed revenue. Partnerships with major companies matter too. If a small solar company partners with Tesla or a big utility company, that's validation. Quarter-over-quarter revenue growth, you want to see sales increasing, not just promises. Let me give you specific metrics to check. Look at their gross margin. That's revenue minus cost of goods sold, divided by revenue. Anything above 30% is decent for this sector. Check their backlog. That's future orders already secured. A growing backlog means future revenue is locked in. Also watch installation capacity. Can they actually deliver on their contracts, or are they overpromising? Real-world example. ABC Solar is trading at $4.20. They just secured a $15 million contract to install solar panels for a school district. Their quarterly revenue grew from $5 million to $8 million in 1 year. Their gross margin is 35%. They have $25 million in backlog orders. These are the numbers that separate real opportunities from hype. Third category, small tech companies in the $3 to $5 range. I'm talking cybersecurity, cloud software, or AI-related businesses. The key here is recurring revenue. Do they have subscription models? Are customers renewing? This is huge because one-time sales are unpredictable, but subscriptions provide steady, predictable income. Look for what's called the net revenue retention rate, or NRR. This tells you if existing customers are spending more over time. Anything above 100% is excellent. It means even without new customers, revenue is growing from existing ones. Check customer acquisition costs versus lifetime value. They're spending $1,000 to acquire a customer who pays them $5,000 over 3 years. That's a healthy ratio. Growing customer count with positive product reviews is what you want to see. Check G2, Capterra, or Trustpilot for software reviews. Look at LinkedIn. Is the company hiring? Growing teams usually mean growing business. Check insider activity. Are executives buying shares or selling? Buying is bullish. Selling might be a red flag. Here's an example. Def Cyber is at $3.80, providing cybersecurity for small businesses. They have 5,000 customers paying an average of $200 monthly. That's $1 million monthly recurring revenue. Their NRR is 115%. Existing customers are upgrading. They just hired 10 new salespeople. Their CEO bought $50,000 worth of shares last month. These signals together paint a promising picture. Fourth category, commodity and mining stocks. When gold, silver, copper, or lithium prices rise, these small mining companies can explode. But here's what most people don't understand. Mining is capital-intensive and risky. You need to know what you're looking at. Look for companies with proven reserves, not just exploration projects. Proven reserves mean geologists have confirmed there's actually valuable minerals there. Check if they have active mining licenses. Without proper permits, they can't mine anything. Low debt is critical because mining requires expensive equipment and operations. Watch commodity price trends. They'll tell you when to get in. If lithium prices are rising because EV demand is increasing, lithium mining stocks will follow. Check the company Sulin sustaining costs, that's what it costs them to mine 1 ounce of gold or 1 ton of copper. If gold is at $2,000 per ounce and their cost is $1,200, they're making $800 profit per ounce. It's healthy. Production numbers matter. Are they actually producing and selling, or is it all just plans? Check their latest production report. Look at their mining jurisdiction. Canada and Australia are generally safer than politically unstable regions where mines can be nationalized overnight. Example time. GHI, mining trades at $2.90. They mine silver in Nevada. They have 50 million ounces in proven reserves. Their all-in cost is $15 per ounce, while silver trades at $25, that's $10 profit per ounce. They produced 2 million ounces last quarter and have no debt. Silver prices are trending up due to solar panel demand. It's the kind of fundamental analysis you need. Fifth and final category, recovery plays. These are good companies that dropped below $5 due to temporary problems. Maybe they faced a lawsuit that's now settled, or pandemic impact that's recovering, or a product recall that's been resolved. Check their 5-year price history and recent quarterly improvements. These can be hidden gems because Wall Street has forgotten about them. The key question is, was the problem temporary or permanent? A temporary supply chain issue that's fixed? That's recoverable. Management fraud or a fundamentally broken business model? Stay away. Look at their balance sheet. Do they have the resources to recover? Check if they're returning to profitability. Look at recent news. Are customers coming back? Compare their current metrics to their peak performance. If they used to earn $50 million annually and now they re-back to $40 million and growing, that's recovery. If they used to trade at $15 before the problem and now they at $4 after fixing it, there's potential upside. But you need proof the fix is working, not just hope. Here's a scenario. JKL restaurant chain fell from $12 to $3.50 during COVID when locations closed. Now they've reopened 95% of stores. Same-store sales are up 20% year over year. They refinanced their debt at lower rates. They're launching a new app that's driving digital orders. Customer reviews are positive again. Business is healing. That's a recovery play worth considering. Now here's how you research these yourself without spending a dollar. Use free tools like Yahoo Finance for stock prices and basic financials. TradingView gives you charts and technical indicators. Your broker's app usually has research reports and financial statements. Look at quarterly earnings reports. Is revenue growing? Are they profitable, or at least reducing losses? Check the debt-to-equity ratio. Too much debt is dangerous. Anything above 2 in most industries is a red flag. It means they owe twice as much as they own. One bad quarter, and they could face bankruptcy. Look at their cash burn rate if they're not profitable yet. How many quarters can they survive? Read the earnings call transcripts. Don't worry, you don't need to listen to the whole call. Sites like Seeking Alpha have transcripts. Read what the CEO says about future guidance. Are they optimistic with specific plans, or vague and defensive? Listen to analyst questions. Smart analysts ask tough questions that reveal problems. Red flags to avoid. Companies with zero revenue for years, they're not businesses, they're lottery tickets. Constant reverse stock splits. That's when they combine shares to artificially boost the price, usually because it's falling too low. Management with a history of failures. Check the CEO and CFO backgrounds. They've bankrupted multiple companies before. Run. Excessive dilution. If they keep issuing new shares, they're diluting your ownership. Your percentage of the company keeps shrinking. Green flags to look for. Increasing sales quarter after quarter. Positive industry news supporting their business. If they make EV parts and EV sales are booming, that helps. Insider buying. When company executives buy their own stock with their personal money, that's confidence. They know the business better than anyone. Strong sector trends supporting the business. Riding a wave is easier than swimming against the current. Spend at least 2 to 3 hours researching before investing a single dollar. I know that sounds like a lot, but would you buy a car without researching it? You're putting your hard-earned money at risk. Respect it by doing proper homework. Here's my personal research checklist that I use. First, I read the latest earnings report. Takes 20 minutes. Second, I check the stock chart for the past year. Any patterns? Takes 5 minutes. Third, I read recent news articles about the company. What's happening? Takes 15 minutes. Fourth, I look at competitor companies. How does this stack up? Takes 20 minutes. Fifth, I check insider transactions and institutional ownership. Who else believes in this? Takes 10 minutes. Sixth, I calculate key ratios, price to sales, debt to equity, current ratio. Takes 15 minutes. Seventh, I write down my thesis. Why will this stock go up? If I can't articulate it clearly, I don't invest. Takes 10 minutes. It's about 95 minutes total. Less than 2 hours to make an informed decision. Listen carefully, Penny. Stocks are extremely risky. You could lose your entire investment. This video is purely educational, not financial advice. I'm not telling you to buy anything. I'm teaching you how to evaluate opportunities. Start small. Do your homework. And never invest based on one YouTube video or social media post. I want you to be successful, but success in penny stocks requires patience, discipline, and continuous learning. Don't quit your job to day trade penny stocks. Don't take money from your emergency fund. Don't borrow money to invest. These are the mistakes that destroy lives. Invest only what you can truly afford to lose and treat it as an education. Even if you lose money, you're learning valuable lessons about markets, companies, and yourself as an investor. One more thing, keep a trading journal. Write down every trade you make, what you bought, why you bought it, what price, and your expected outcome. And later, write what actually happened and what you learned. This journal will become your most valuable asset. You'll see your mistakes clearly and avoid repeating them. You'll see your successful patterns and can double down on what works. If this helped you, hit subscribe for more beginner-friendly stock market content every week. Comment below which category interests you most: biotech, energy tech, mining, or recovery plays. Also, tell me what's your biggest fear about investing in penny stocks. I read every comment, and I'll make videos answering your specific questions. Remember, invest smart, stay educated, and I'll see you in the next video where I'll break down exactly how to read a balance sheet in simple English, no finance degree required. This is Stock Mind Academy, building wealth, one smart decision at a time. Don't forget, patience and knowledge beat gambling every single time. See you soon.